Hi, my name is Akiba Leisman. I'm the CEO of Mako Mining. And the way that I like to describe it is that we're doing three things in northern Nicaragua. First and foremost, we have now commercialized what is the highest grade open pit mine in the world. Nameplate capacity is 500 tons per day. We declared commercial production on that July 1st. So I'll be reporting our first commercial production quarter this coming November. Secondly, we've made a discovery a couple kilometers to the south of San Albino. The intent is to go and develop that into a resource and get that permitted and start mining Los Conchitas alongside San Albino by the very end of next year, and to expand our operations at 1,000 tons a day by the very end of 2022. And thirdly, and what I think is the most important part about this company, is that we do think that we're sitting on an orogenic gold mining camp over here. We've just scratched the surface from an exploration perspective. Everything that we're finding from a prospecting perspective is confirming what we truly believe to be a very, very special mining camp.
Akiba, good to see you again. We spoke back, I think, early July, I think possibly. A lot has happened since then. Just wanted to dial in for a quick update. Where I want to go with this, I want to start with cleaning up balance sheets. Okay, you made an announcement about the extension of the Wexford loan. I noticed also Sailfish have loaned you $8 million to maybe take out Nabari. What's going on there? Why all this tidying up, and why now?
Right. So let's go over about what the capital was needed for. So when the management changes happened in 2019, there were two tranches of equity capital that came into the company. The first was a backstop rights offering in July of 2019 for about US $20 million. The second was a syndicated underwritten bought deal in July of 2020 for another US $20 million. 12 of that went to Wexford, and 8 of that went to the broader markets in a well executed bought deal. And then we actually got hit by a couple of major hurricanes right in the middle of construction in early November of last year, pushed back kind of the commercialization of the asset by about 3 months. So in February of this calendar year, we took a loan from a third party called Nabari in the amount of $6.4 million, which is enough capital to continue our exploration program, to keep the working capital in place, and for any startup issues that we had. This summer, because of a confluence of events that we'll go over in detail later, we decided to refinance that Nabari facility. So that has been refinanced by a finite tenor gold loan from an affiliated entity called Sailfish Royalty Corp, which I'm also the executive chairman of. And then with that money, we were able to remove any financial and balance sheet covenants associated with it. The mine has been very cash generative since the end of May over this year. So we no longer have to deal with true third parties over here. And we now have infinite flexibility of our balance sheet, inclusive of investing in exploration and frankly, even capital returns to shareholders. So we've announced a buyback with cash going back to our shareholders now that we have excess cash coming through the operations.
But isn't that kind of, it's kind of the problem? I think some of the questions being sent in, and some of the data is looking at this are going, hang on, this seems to be the Wexford Boys Club here, right? But you raise $20 million, you give 12 straight away to Wexford. You raise $8 million, you give 1.8 of that to Wexford. You know, we talk, we talk share buyback. Should you be putting money into the ground, or should you be, buying shares? A debate that different people will have different attitudes on. You can sort of see why people feel that Wexford seem to be doing this for their own benefit. Is that a fair accusation?
So a few things to that. First of all, Wexford is an economic entity, right? So they are a private equity and hedge fund group. They are looking out for their own objectives. I am looking out for my own objectives. Investors in Mako should be looking out for their own objectives. That being said, really everybody's main goal over here is to make sure that the company's business plan is fully financed, that we're able to grow into what our 3-stage objectives are. And they are supporting shareholders in that regard. So I get into this discussion a lot with investors, with other corporates, frankly. Anytime that we talk to them about the structure of Mako, it's like, all right, well, if we're an investor, how do we get Wexford down to a lower level? If I'm a smaller medium scale company, is like, all right, maybe we can enter into an M&A discussion. How do I get Wexford less in an influential position over here? The truth of the matter is we are a junior mining company, and we have truly one of the most valuable assets that I know of, which is a very sophisticated, very well capitalized investor who's willing to actually protect the downside over here. So when we go through some operational difficulties, there is capital over there. Everything that we needed to do in financing our 500 tons per day, 1,000 tons per day, finding the orogenic camp over here, we always knew that there was going to be the capital to go and invest in it. So the long-term objective of the company is to make this certainly more of a normal and a traditional company. But while we were in our growth phase, it was a tremendously valuable asset to have a backer like Wexford really to provide all the support that we needed, not only to advance the business objectives, but even going back in the past to actually create Mako. If it wasn't for Wexford, the formational transaction of combining Marlin and Golden Rain would have never happened.
So are you having difficulty raising money elsewhere? Is that the problem? Because, the Wexford loan, what's left, 12.9 million bucks at 10%, it's pretty chunky. Surely you'd want to remove that as quickly as possible. And I don't know, I can't remember what the terms are with Sailfish on the 8 million, but again, how are you going to manage this? I know you're producing at the moment, but it seems to be all the money's going back into the debt. We're talking about exploration in a minute, I hope, and I just want to get a sense of how you balance those obligations out.
Okay, so there's a couple of parts to that question. One is access to capital, and then one is just the basic terms and kind of just capital allocation decisions based on the price of capital. So the availability of capital, there's really been, this I think is the fundamental piece of confusion that comes with really any of our portfolio companies within the gold mining space. We always have the capital available to complete our objectives, but the primary kind of ideal is to have the public companies support themselves. So we go through these it actually allows us to be very disciplined kind of managers and stewards of public capital by seeing if the individual companies can go and raise capital to advance their business objectives. But to the extent that capital is not available, yes, Wexford is kind of always there in the background. It was a tremendously valuable asset for that to happen. That being said, because we have a Wexford in the background, I don't actually have to fall into the trap of kind of convincing shareholders that my company is something that it's not. And I think this is kind of like the fundamental problem in a capital starved industry, that I use that term a little bit loosely, in that generally speaking, if investors knew what the real terms were and the real returns were for the individual projects collectively as a whole, there would be no investor that would be investing in the average project. So we have two things that is very valuable. One, we actually have a project that is meriting capital to be invested to create the project, which is unique. I would say less than 10% of the companies out there can actually have a project that's actually deserving of capital. But likewise, we're in a great situation where we can actually tell people the truth about what we have. This is what Nicaragua is. It's not all like sunshine and rainbows over here. There's a lot of difficulty to get the gold out. But by being open and transparent, is that if investors want to come along for the ride, they're more than welcome. And if they don't want to come along for the ride, we still have the capital available to us. Now, from a price and returns perspective, the Wexford loan right now is yielding 10%. If it's extended past February of next year, there'll be a bonus payment of 500 ounces of gold on that. So it is definitely our intent to repay really the entirety of the principal before that happens. We did announce a buyback associated with that, not associated with a loan, but a buyback kind of in connection with the general balance sheet restructuring, saying that if our stock was trading at the levels that it was a couple of weeks ago, at the end of the day, we'll be there to support the stock. But our primary focus is to get that debt repaid to zero. And then once the debt is repaid in early of next year, our full intent is to repurchase all 33 million shares that we announced in the buyback.
You used an interesting phrase there about telling the truth to the market. I had a conversation with the CEO the other day. We were talking about feasibility studies, and he's saying, well, I could choose to use this as a marketing tool, or I can use it to actually work out what the economics of my project actually are. I've got two choices here. And the former happens more often than the latter with mining companies. So I appreciate the point you make there. There's a degree of, or there's more honesty in having the facility of a big private equity balance sheet behind you. So I think that's probably not been said very often or enough. Look, I just wanted to go there because I think there's enough. There's a bit of negative chat around. Well, what is Wexford trying to do here? Is it trying to suck out all the value, or is it trying to get a fair return on its investment to date? I've heard your story. Can we talk a little bit about obviously what's going on at San Albino? You're in the optimization phase, right? You started pouring, I think, just after we talked, or just before we talked, I can't remember. Beginning of July,
a little bit before.
Right?
So,
right?
So first, the high grade started to be put through the mill in mid-May. We actually technically had a gold pour in January, a small gold pour in January this year. But we started to put the good stuff through the mill on May 12th, and the mills were kind of running at levels that we would deem to be commercial at that time. And then it would have been an accounting nightmare if we declared commercial production intra-quarter. So we kind of pushed back commercial production declaration to the first day of Q3. So this last quarter was the first full quarter of commercial production.
Okay, and so when was the next big announcement?
So with on that front, we're going to be putting out our first commercial production accounting numbers for Q3, which will likely be out the third week of November, and then that will have a comprehensive accounting of our costs. And then likewise, there's going to be very, very large movements of working capital because prior to the declaration of commercial production, kind of all of our inventory, our stockpiles, which was aggregating to over 12,000 ounces of gold, everything in circuit, which was aggregating to over 3,000 ounces of gold, was all kind of put to long-term property, plant, and equipment, a long-term asset. All of that at cost gets moved back into the current category. So there's going to be a much higher than $10 million positive adjustment to working capital when we announce our numbers in November, along with our comprehensive cost accounting.
Simplify that for your audience. What's it mean?
So to simplify that from the audience, if you take a look at our Q2 financials, there's a big working capital deficit. That, for all intents and purposes, goes away in Q3.
Okay. You went into financial speak there, I think, which is fine. Okay, so look, you've also got to manage that narrative and manage expectations here, because I think at 250 million, I think you're fully valued here. You're going to need to show more from the exploration play. You're going to need to show more resources. But I appreciate you. I mean, actually, just coming back on the production front, has it been all plain sailing? Because obviously, mining's tough. It's the optimization phase. What are the things that you hadn't expected or had expected and definitely happened, which have maybe slowed things down? Right.
So the plant was, for all intents and purposes, complete at the end of Q1. So March 31st, we had all the kit developed. So there was like two stages of kind of teething issues that we needed to address. There was the crisis level teething issues, which occurred in April and then the first 2 weeks of May, where the two primary circuits of our plant, the gravity circuit and the intense cyanide reactor to process golds through gravity, and our carbon and leach circuit, for two very disparate reasons, couldn't actually get gold at the back end, right? So if you are a mine that doesn't have the ability to actually get the shiny stuff out the door, you can very well get into a cash crunch. So I would consider April and early May to be crisis level issues, and luckily we were able to resolve those on the week before May 12th. And then really since that time, the mine has been profitable. Now we're in a situation where it really is more about fine tuning. and fine tuning in the context of kind of where we are in this global logistics crunch that we're operating in right now. So for June, July, and August, and even to a certain extent September, we had various bottlenecks and adjustments that needed to be made where it was not ideally located within the plant. And so a couple of situations over here. So we had our filter cloths from the filter press were kind of not cleaning the water good enough. So we had very high turbidity water going into our Nelson concentrators, and that just gummed it. So the gravity concentrator became kind of a bottleneck. That's not where the bottleneck should be. We had an issue where some of the historical timbering with these little toothpicks that the old timers left with their ground support from the late 19th century wound its way into the plant. You got these little toothpicks that started to gum up our screens in our elution circuit. We needed to deal with that. We actually had to develop a little workaround to deal with those toothpicks getting into the system. Then we also had really an unprecedented situation. It's kind of unique. Certainly, I've never experienced before from a labor availability side. Really, from end of June to early August, where we had quite a few people decide to emigrate from Nicaragua to the United States because of economic reasons. It was really a once in a lifetime opportunity for there to be not only open borders, but also economic incentives for people to work in places like Florida. So we lost a lot of people through turnover in July, and luckily that's been rectified. We had to adjust salaries across the board to make sure that everybody was incented to stay over at site. But to lose some pretty well-trained people was problematic. All of this I would put into kind of like getting everything up to speed. So, for instance, our nameplate capacity is 500 tons per day, and what that really should mean is that you're running 525 tons per day at around 95% availability. So multiply those two numbers together, you get roughly 500 tons per day. We've been averaging for the quarter 429 tons per day at 85% availability. So that's about kind of high 70% of where we need to be. The mine is like really cash generative right now. I mean, our operating costs are $2 million bucks a month. The revenue that's coming from that, we were producing probably an average of $2,750 a month. Now that we've actually fixed some of those bottlenecks, and the bottlenecks of the plant are where they belong, those numbers are going up pretty significantly. So we're going to be we'll be close to 4,000 ounces for this month. We'll be over 10,000 ounces for the quarter with operating costs pretty similar to what we had in Q3. So these are the fine tuning issues that we need to go through. We're not quite there at nameplate capacity, but we'll be there this quarter. And in the meantime, the mine is gushing cash.
Okay, so I'm a former analyst. You're an analyst. The way you went about doing the numbers before you actually get your hands dirty and recognize that toothpicks can be a problem for you, do you think that's going to make you better at your guidance and forecast numbers going forward, because you've got a better appreciation of actually how hard it is, the problems that do come up, the issues that will occur? It's a personal thing. I'm not necessarily about the company. I'm just about you.
Whether it makes me a better financial analyst, I don't know. It certainly makes me more humble, right? There's no question about that. The last 12 years of my career has certainly been a learning experience. But yeah, and actually, even from on the investor side, like everybody has to understand, mining is difficult. Running plants are difficult. One of the things that our group actually is very, very good at is problem solving. So I would say the ability to have these things thrown at us, we do have the capacity to fix them in pretty short order without things getting out of control. And if it really wasn't for having a group like we had, we could definitely get into trouble. But it's certainly a risk that investors need to be cognizant of. This is not just moving paper around the desk.
Well said, and that's not said enough. Investors sometimes get told the kind of shiny version, which is paper-based and not necessarily, it doesn't have the benefit of experience or the truth being applied. So that's well said. can we just look at this kind of backfill valuation thing? So whatever you think, right? Whatever I think, whatever you think, we may not agree on it, but I think there's a bit of backfilling or valuation needs to be done here. What are the tools available to you? Obviously, you're going and doing some share buyback, right? Whatever you think, whether that's a good thing or bad thing, I think I'd prefer you to be putting money in the ground in exploration, but let's not have that debate now. But what are the things that you're going to do? I'm assuming you've got to keep the production running smoothly. You've got to optimize it and get that going. I'm thinking more of the blue sky, because your problem for me is scale. And if you've got the orogenic component, that could be really interesting. If you've got more of what you've got today on the higher grade stuff, that's great too. But what are you focusing on?
Yeah, so I don't even view this as blue sky. I think it is fundamental to the company what we are doing right now, and it triggers a lot of people when I say this. It kind of you get this kind of myopic view about what Mako is. We're not really a production company. We are an self-funded exploration company, right? So the mine is there to support what we're doing, kind of in the direct expense potential, and then eventually from a regional perspective on where we are. Now, the reason why I say people get triggered on this is it can go in both sides. They're the people that say, all right, you're a producing company, let's say you're going to be doing mid 40,000 ounces a year. Granted, this is going to be stuff that's going to be well in excess of $1,000 margins associated with it. So even at 40,000 ounces a year, this is an extremely, extremely profitable mine. But I get your point in terms of getting this up to scale where you can actually have these check the box approaches to mine investing that a lot of analysts have out there, that needs to be of a certain production profile, 100,000 ounces for argument's sake, certain reserve life, et cetera. That's not the reason why the plant was developed in the first place. The plant was developed in the first place so we can understand the geology. It is not a simple geology that what we have over here. We went through painstaking details with that geological model and resource update that we put out last year, that I also thought was taken by the market in two very different directions over there. That was a very, very important milestone for this company, because it was the first time that you actually had a model that was representative of the geology. It had nothing to do with the size of the resource, but it allowed us to actually have the understanding for what San Albino is about, so we can actually use that as an analogous model to what we have elsewhere in the property and eventually underground to all of these deposits. So that 270,000 ounce resource that we developed at the end of last year was really just the starting point for us to understand the rest of the property, to know what we're actually going after. So now we don't have to worry about the financial markets. You don't need to raise capital. Everything is cash flow generative. And then there's step 2 and step 3. Step 2 is to get to scale, to bring in some of these near mine expansion opportunities, Los Conchitas, then even directly associated with San Albino, to get this up to a profile where people could say, all right, you're now operating at scale. But even then, the game here is to go and unlock the code for this orogenic gold mining camp. And everything that we're seeing from a prospecting perspective has every indication that this type of camp is going to wind up having an endowment in the millions of ounces of gold when all is said and done.
Right. I mean, do you feel slightly, this comes back to the beginning of the conversation, right? So we had that conversation last time about the purpose of San Albino, right? And we got there, we understood it, and you were looking at the potential of what else is out there, and that's where the true value in the future lies. But in the meantime, you're slightly paralyzed with the Wexford loan overhang there. You don't want to get caught out and have to hand over 500 ounces. You don't, and you've also got to pay back your I don't know what you call it, sister company, portfolio company, in the shape of Sailfish. That you owe them some money to. Do you feel that you can find a way through by maybe going and raising some money in the open market, or do some of the confines or constructs of the loans prevent you from doing that? Because only when you sort the balance sheet out can you really allocate capital the way you want to unlock the potential through exploration, surely.
No, I would actually disagree with that. Everything that we're funding right now from exploration is not capital constrained. It really is human resources and logistical resources constrained. So we currently have 3 rigs on site. We've contracted another 2 rigs on site that they also have been kind of caught in the global logistical supply crunch. So frankly, they should have been at site a few weeks ago. Hopefully they'll be at site in a few weeks' time. And then the 5 rigs that we have are going to be sufficient to kind of get Los Conchitas kind of into a secondary production center of next year. And then we're right now in the very late stages of getting our drilling permits on our 2 other regional concessions, Puerto Rios and Segoviana. Once that happens, we'll allocate drilling to that. There is not a single, truly, there has not been a single target that we basically said, we're going to have to defer that because we don't have capital for it. So number 1 objective, and this is me as management, Wexford as a shareholder. I used to work for Wexford. I talk to them often. They're a very large shareholder, so I need to talk to them often in that regard. Everybody is supportive to finance everything that we need to do steps 1, 2, and 3. Beyond that, because the cash coming from the mine is beyond what we can actually feasibly invest and reinvest in the ground. At that point in time, that capital is going to have.
Give me that guidance number.
Yeah.
Give me the guidance number, Akiba. So what are you telling the market that the mine is going to be able to contribute as free cash flow to you?
So we've given little snippets publicly in terms of what the mine's cost basis was. So for 2 of the 3 months of this quarter, we were averaging about $1.9 million of mine site costs. Assume that last month in September was roughly the same in terms of what our cost base. So let's say round number of $2 million. That is basically everything that we need to run the operations. Our mining costs, our processing costs, our mine site G&A, and then our external G&A to Nicaragua directly associated with the mine. Even when the mine was running at about 75%, this was a mine that was producing and selling over 2,700 ounces a month at 1787, I think was like our average price of gold that we got. So even in those 3 months, this was a very cash generative mine. Now we're taking a step up. This month, without a very material increase in our processing costs, so that's really the only variable that will increase. We're going to be producing close, potentially even more than 4,000 ounces this month. We'll be over 10,000 ounces for the quarter, and then you can do the math in terms of what that's going to mean from a profit contribution. In terms of what we're spending on exploration, now with the 3 rigs, it's probably $600,000 a month. That will probably increase to about $1 million thereabouts when we get the other two rigs, all of which can be funded. Now, on the Wexford loan, I would love to repay that back quickly. So if our stock trades well, then great. The capital will be allocated to principal repayment. The stock trades in the dumps. We also have an opportunity to repurchase shares, although my preference is to repay debt. Once that loan is repaid, though, our full intent is to repurchase those 33 million shares in total, and we will have more than enough capital to do coming from the mine without actually having to raise capital from the outside. But this is not a company that is capital constrained in terms of what is being reinvested in the ground.
Okay. Part of the question was around what were the restrictions or covenants on either of the loans. It sounds light.
There's really none. And actually, that's the primary reason for the refinance Nabari. And by the way, Nabari was great, right? So like if any junior money company wants to borrow money from somebody, you can call me. I'll give you Nabari's numbers. They're fantastic to deal with. But it was not a sister company. There is a step change in flexibility when you're dealing with a loan from Wexford, when you're dealing with a loan from Sailfish. And I was telling you earlier, it was like last year. It was great. We had the winds at our back. We had it was a gold bull market. I did, for the first time in my career, I did a vanilla equity raise to the public markets. It was great. I met with 26 investors. Did it all on Zoom because it was dead smack in the middle of the pandemic. We had a slightly oversubscribed facility. It was fantastic. hunky-dory. I thought I was a normal company last year. Guess what? The gold bull market was probably a little bit of a false start. We're not a normal company yet, but part of our abnormality happens to be the fact that we have this wonderful asset in terms of the mine, which is special. And we have this wonderful asset, which is our shareholder base, which is also special and unique for this industry.
It's true. Last year it was quite bizarre. Lots of companies being offered money that they shouldn't have been offered, but I think that that's coming home to roost this year in some cases. Okay, for you looking forward, I think you kind of laid out what your objectives are and how you get there, and I guess we're looking at from mid-November for these numbers to kind of confirm what you've just said, and you're off and running at the races. It's easy breezy mining now, isn't it? From now on.
Yeah, it's obviously there's a lot of challenges to running. I would say one of the hard parts about the pandemic is that I wasn't able to get the site. Right, so it was probably 14 months for me to be away from site. Even our core operating team, there were periods of time where we had to charter a private jet for one or two times in order to actually get some people relief to get in and out of the country. Now it's a little bit easier. So I go back to site every 2.5 months. But even then, I really do like to be at site every 6 or 7 weeks is my normal course, just to get a better flavor for what's going on. So it's a challenge to run companies from afar.
Brilliant. Well, perhaps you come back on before Christmas, let us know how you got on, because it sounds like things are starting to motor now. So appreciate your time today, Akiba. We'll see you soon.
Okay, appreciate it, Matt.
Cool.
All right, take care.